Welcome to this explainer. Look, if you've ever peeked at options trading and thought, wow, this is just a chaotic casino, well, you definitely aren't alone. Today, we are stripping away all that confusing jargon and breaking down how to trade call options methodically. We're literally going to shift your mindset from a gambler to a strategist. Let's get right into it. Okay, so here's our roadmap for the day. We've got 5 stops. 1, the power of leverage. 2, the 90-10 portfolio blueprint. 3, executing a call option. 4, spotting the right setup. And 5, winning strategies and traps. All right, section 1, the power of leverage, specifically looking at capital efficiency. Let's put this into perspective. If you wanted to go out today and buy 100 shares of Tesla stock outright, you'd have to drop a massive $17,000. I mean, for most of us, tying up that kind of cash in just one position is incredibly risky, or honestly, just flat out impossible. But buying one single Tesla call option, that might only cost you around $700. You are essentially controlling the exact same amount of underlying assets, but without risking your entire bank account to do it. It is an absolutely incredible advantage. But before we get too far ahead of ourselves, let's nail down exactly what this is. When you buy a call option, you're buying a contract, and that contract gives you the right to own 100 shares of a specific stock. But, and here's the kicker, without having to pay the full price up front. That upfront cost, like that $700 in our Tesla example, that is your maximum risk. It's literally the absolute most you can lose, while your upside potential stays completely attached to how those 100 shares perform. Moving right along to section 2, the 90-10 portfolio blueprint. This is all about balancing stability. Listen, this 90-10 blueprint is your survival guide in the market. If you want to grow an account without risking total financial ruin, you absolutely need to keep 90% of your portfolio locked into safe strategies. We're talking long-term stock holds, ETFs, income generation, the boring but safe stuff. Then, and only then, do you take that remaining 10% and allocate it to your high-risk, high-reward plays, like buying call options. Doing it this way means if you completely whiff on a trade, hey, your portfolio is safe. You're never betting the house, but you still get that exciting exposure to massive portfolio-boosting moonshots. Let's jump to section 3, executing a call option. Time for a quick trading tutorial. Keeping things super simple and actionable here, actually executing a call option takes just 4 straightforward steps on your brokerage app. First up, search for your stock ticker, say Tesla or Starbucks. Second, pick your expiration date. Now, strategy-wise, if you're making a short-term bet, you go with a near-term date. Going long-term, pick a date way out in the future, which is known as a leap option. Third, you set your limit price. And finally, review and confirm your order. Bam, you're in the game. But actually, let's rewind and zero in on step 3 for a second, because that is where a ton of money is lost before the trade even officially starts. You have to understand the difference between a limit order and a market order. A limit order is a specific middle ground price that you set to ensure your order gets filled fairly. Guys, it is so absolutely vital to use a limit order. If you just hit buy at the market price, your brokerage might hand you a genuinely terrible price. On the flip side, if you try to super lowball the market, your trade is just going to sit there collecting dust and never actually execute. Think of the stock market like an endless negotiation. You have buyers, represented by the bid price, who want to pay, let's say, $6.90 for an option. Then you have the sellers, represented by the ask price, who are holding out for $7.10. If you punch in a limit order for $6.90, your chances of getting filled are practically zero, right? The seller has zero incentive to drop their price that low. But if you look at the midpoint and set your limit right smack in the middle at $7 even, you are highly likely to get that order filled. You're just meeting the market halfway. Okay, section 4, spotting the right setup using technical analysis. So buying a call option is an inherently bullish strategy, meaning you need the stock to go up. And one of the absolute best ways to find a stock ready to move up is by using a technical metric called the RSI, or Relative Strength Index. Spotting a low RSI is a fantastic technical indicator that an asset is heavily oversold. It basically means the sellers are completely exhausted, the price has been beaten to a pulp, and it might just be the perfect opportunity to buy a call option before the stock inevitably bounces back. Let's look at how this plays out in the real world. Imagine you pull up a chart for Adobe. You notice the stock has just crashed massively, tumbling from over $600 all the way down to $473 after a brutal string of red days. Then you glance at the RSI, and it's sitting at 38.
That is firmly in oversold territory. This tells us there is serious potential for a highly leveraged reversal. The bearish momentum pushed it down so far that it's basically a coiled spring, primed to bounce back up and bridge that gap. If you buy a call option right near that bottom and the stock reverses upward, well, the sheer power of leverage means you are going to see a huge, rapid rise in the value of your option.
Which brings us to our final section. Section 5, winning strategies and traps. Basically, how to avoid the gambler trap.
We need to drop a harsh reality check here, coming direct from a Wall Street and Goldman Sachs veteran. Buying short-term call options without a highly specific catalyst, like say an upcoming earnings report or a major product launch, is essentially a trap. It is literally the fastest way to drain your account.
7%. Just let that number sink in for a second. That is your actual statistical chance of success if you buy an out-of-the-money short-term call option, just crossing your fingers and hoping a stock randomly shoots up. 7%. You need the stock to move up like crazy within a tiny little window of time just to break even. At that point, you aren't strategizing anymore, you're literally just gambling. So how do we actually fix this and trade smart? Look, with out-of-the-money options, yes, I know they look incredibly cheap, but they're cheap for a reason. They have that terrible 7% success rate, horrible trading volume, and a wide bid-ask spread that instantly puts you at a huge disadvantage. To actually protect your portfolio, you should aim to buy options that are closer to or actively in the money. Sure, they're going to cost you a decent bit more upfront, but your distance to break even is incredibly short. The stock only has to move up a tiny bit, and boom, you are mathematically in the green, making real money. That is a calculated strategic play, not a scratch-off lottery ticket. I want to leave you with this provocative final thought on flexibility and discipline. There is this huge misconception out there that you have to hold an option until its expiration day. You absolutely don't. You can close an option at literally any time. If you buy a contract and 10 minutes later the stock spikes and you are suddenly up $30, are you disciplined enough to secure that quick profit, click sell, and walk away a winner? Or are you going to hold on hoping for $100 only to watch it turn into a loss? In the options market, nobody ever went broke taking a profit. The real question is, do you have the discipline to actually take it?